how the valuation relative to its own history, relative to its own fundamentals, and from the various macro perspective, how what should be the valuation of that particular theme or sector, and what valuation at which it's currently trading. Doing the factor investing means quality, growth, value, depending upon the situation where you want to invest, where you invest, and how that particular style performs, you generate an alpha. So there are various means in which fund manager try to create alpha that we follow. We try to see it on a daily basis, and whatever allocation that comes, we try to rebalance the equity and debt portion accordingly. So one is from the asset allocation, one is from the theme or sector allocation, and third one is from the market cap allocation. How much you want to invest in large cap, mid cap, and small cap. As an investor, there are various means by which one can create the alpha. One is by creating the asset allocation, means how much you want to invest in debt, equity, gold. Another one is the way in which you can create alpha is allocating to various theme or sector. How much you want to invest in particular theme or sector. That is also a way of creating alpha. Third one is between the market cap, between the large, mid, and small, how much you want to invest. That also create an alpha. It is a way in which as a fund manager, we try to create alpha. And another one is by doing the factor investing, means quality, growth, value, depending upon the situation where you want to invest, where you invest, and how that particular style performs, you generate an alpha. So there are various means in which fund manager try to create alpha. Now for all this, for retail investor or individual investor doing all this thing, when to invest in equity, when to invest in debt, when to invest in gold, or when to invest in which style at particular point in time, and in which market cap segment he should be going. Because see, at various point in time, each market cap segment, each theme or sector will behave differently, and they give a different return over a period of time. It is not that at all point in time the all themes and sector will perform, all market cap segment will perform on the same time. So, and all asset class also doesn't behave in the same way. There is a, for some asset class there are negative correlations, so some does well, another does not do well. So here comes the expertise of the fund manager, where he tries to decide on which market cap he wants to go, how much he wants to go between equity, debt, and which style he wants to invest currently. So for retail investor, it becomes difficult because it involves lot of experience, judgment, studying the market, studying various data, and day to day. Obviously, it comes to track the market also day to day, when to enter, when to exit. So this is one problem that individual investor face. And second one is, while doing all this switch, now let us assume that he understands the market well, and he decides on where he want to invest and where he want to enter, when he want to exit. But while doing that also, there is a tax incidence also gets created on the side of investor. So one, there is a continuous need to track those things. Another things, he incurs the tax liability also whenever he makes a decision to enter and exit. There is a tax incidence also gets created. So to solve this problem, uh, we have come out with the various products within the fund of fund basket, which actually invest in the mutual fund schemes, and solves this problem that I have mentioned so far. So first one is, this is asset allocator fund. So again, here we try to create alpha by investing in debt and equity. Between, we decide in how much we want to invest in debt, how much we want to invest in equity, and that is the way in which we try to create alpha. So this is the product which is suitable for the investor which has a slightly lower risk appetite. He does not want to take a higher risk, and okay with the asset allocation kind of a product. This is the product, this is an all time favorite product, whatever be the market valuation, wherever the market valuations or the returns are there, you can recommend this kind of a product to an investor. Because what happens, this fund, how we decide, first understand how we decide on the equity allocation. Now, firstly, if you see, you know, equity, as you know, over a longer period of time is a wealth creating avenue for the investor. And here is the return that I was talking about, that each asset class behaves differently. Sometimes equity does better, sometimes debt does better, and our job is to allocate between both of them, so that we create a alpha. And there is a research paper also says that, you know, the majority of the alpha comes from the asset allocation. This is the most important criteria or most important factor when you invest. If your asset allocation doesn't go right, then there is a high possibility you might not create the decent alpha for the investor. And see, what Warren Buffett says, you have to be fearful when others are greedy, and you have to be greedy when others are fearful. But actual, if you see, reverse happens. Now, if you see, there are some data points that shows when the valuation is high, there is a DI flows, means how much money we are getting from the retails investor, from the investors. So if you see, all are positive when the valuations are high. Same way, if you see the lower table, when the valuation are low, we are seeing high outflows, because this is the periods where there will be a correction in the market. Valuation would have been attractive, but investor thinks that there can be more downside, let me go out. So exactly reverse happens, they think pro cyclically. So again, you know, you study the historical data, following the counter cyclical approach helps in creating a better alpha. So as I was mentioning, you know, it solves the problem of investor. Now for investor, you know, which asset class to invest, they get confused. uh, with this fund, try to solve those kind of a problem. So as I was mentioning, there is a taxation also, you know, as a mutual fund, when we do enter and exit into particular scheme, the tax incidence doesn't get created. So even the investor doesn't get affected by that rebalancing. Whereas investor, if they do buy and sell, they have to pay tax also. So this fund in a way is a counter cyclical in nature and try to follow the philosophy which Warren Buffett suggested, you know, be fearful when others are greedy and be greedy when others are fearful. So when the valuation goes up, we reduce the equity. When valuation are low, we increase our equity exposure. This is the market chart. So this is the, you know, even you can see this chart, we publish it every month in our fact sheet also. Currently, if you see, it is in the green zone, lighter green zone. That suggests that the risk reward will be much better if you invest in equity now. This is based on the various indicator we use, like price to earning, price to book, GSEC yield, what is the market cap to GDP ratio. Various quantitative indicator is being used in making this valuation index, and this model is also used this kind of a index to decide on how much we want to be in the equity. Along with this, we also use the yield gap measure that sees the relative differential between the debt yield and the equity yield, to see the relative attractiveness and how much we want to invest in equity and how much we want to invest in debt. Yeah. Yeah, so this is the fund. So the broader, what is the range we follow here? Equity, we try to be between 35 to 100, and for the debt we have 0 to 65%. And this is the where we do daily rebalancing based on the various indicator that we follow. We try to see it on a daily basis, and whatever allocation that it comes, we try to rebalance the equity and debt portion accordingly. uh, so for the investor, I think the tax rate, if it is holding for more than 2 years, it is 12.5%, like any other asset class. So that way, I think the 2 3 years back the changes happen in the budget that makes it this also as a 12.5% tax slab, 12.5% tax against the tax slab earlier. Uh, so this is from 2019 we started actually implementing this in the fund, and before 2019 it was a back tested model based data, but from 2019 it is actual NAV we have used. And if you see from 2010 to 19 it is a model that we are following, it is a model NAV, and from 2019 to till date it is the actual NAV because we started implementing in 2019. If you see over this period, the scheme and plus model has given a CAGR of 11.8% versus a Nifty return of 11.2%. And if you see, average equity level during this period is just 42%. So with 42% equity exposure, we almost given a better return than the equity. So we call it as a better risk adjusted return because this is the product for the investor who has a lower risk appetite. It comes with a lower volatility also because at different point in time it will have a different equity exposure that creates the lower volatility also in the product. So this is we have shown the level currently. Right now the equity level is roughly 60%. If you see with correction it increases the level, and when the market was down during the COVID period, if you see yeah, one second. Yeah, this is the level. If you see during the COVID period, 2020, it has gone as high as 83%. And then if you see following that period, 2022 23, the because of the valuation and all, the equity allocation has been reduced. And if you see over a period of time when the market has seen the correction, we have increased the equity allocation. And this is, currently we are sitting at almost more than 60% kind of a equity exposure. See, this is another, we have picked up some, data points, period of returns where market has given almost nothing, 0% return, but this scheme has given return. So when even market flats, because of the allocation to debt also, we earn some yield. So during this period, when the market has not given anything, we have earned return on our investment. And this is some data points. And as I was mentioning, this will come with the lower volatility. If you see the standard deviation, it has a 3.6% versus a 5.1% standard deviation for the market. And if you see negative observation, just 5% negative observation versus market 8% negative observation. And if you see the lower end, like above 10 to 15% and 10 above 15%, there is almost 83% observation versus 75% observation. So the in a nutshell, it tries to provide better risk adjusted return for the investor. Obviously, when market zooms up, this will not participate 100% because there will be always some allocation to debt will also be there, but on this will also act as a defense when the market goes down. Because of the lower equity, it protects your capital also in some way. This is since 1st March. So this is 5-year rolling return and this is a 3-year rolling return data points we have taken. Again, if you take a 5-year rolling return, the observation improves further. So this is the various data points we have picked up when the market is falling. This product does not fall to that extent. In fact, it sometimes provides a positive return as well. In case of a range bound market, also it gives a better return. And rising market, as I mentioned, because of the lower equity exposure, it will underperform. But over a longer period of time, if you see, then the outcome is much better. So this is as on 31st March return. If you see last 1 year when Nifty has given a -4% return, this fund has delivered a positive return 1.3%. And over a period of time, if you see, generally alpha gets created Since if you see, as I earlier it was mentioned in the seat also, since 1st March 2010, I think 11.8% scheme return versus 11.2% Nifty return. And I think if in fact actual, if you want to see last almost 5 to 6 years we are running this product, actually implementing this product, and if you see the fund has given a 15 almost 15% return versus a market return of 18% return with the lower equity exposure. Lower equity exposure means the lower volatility, better risk adjusted return. Yeah, I think these are the data points. Yeah, this is okay. Yeah, this was I was mentioning it protects from the fall also. Hmm. Yeah, I think that's it for this one. Uh, yeah, as I was mentioning, right now it's 61% equity and 39% in the debt. This is the broader allocation within the equity and the debt. His idea is to create alpha from the asset allocation, while equity also we try to see from the sectorally where we want to put our money. Not skewed call are taken here because objective is to generate alpha from the asset allocation, not from the too much alpha from the sector. Because if I skew my to investment in a particular sector, or then again it increases the volatility and the risk, which we don't want, because the idea is to generate only focus on the asset allocation. Now this is one product, this is the all-time favorite, you can recommend anytime to investor, because anyway when the market valuation is high we will be at a higher lower equity level, so the capital gets anyway protected for the investor, and when the market goes up it helps them rather than timing the market. Yeah, I think then another way in which the one can create alpha is allocating to various theme or sector. This is the product which is all equity product. It is bit aggressive in nature because in a way it doesn't try to take a cash call. Earlier it was thematic advantage fund of fund, where we were investing at least 80% in the equity theme schemes, theme or sector based scheme. But with a change in some SEBI regulation, we have to restructure it to aggressive hybrid fund. So idea is the same here. We try to generate alpha from allocation of the theme or sector. So there will be skew towards particular theme or sector at particular point in time. Whereas in asset allocator, it is all how much you want to invest in debt, how much you want to invest in equity. Uh, Generation of alpha from the asset allocation. Here, generation of alpha from the sector allocation, sector theme allocation. It is a very aggressive in nature. So it is not a you can recommend at any point in time to investor. Here we try to take exposure on the particular theme or sector which are expected to do well. Now so just the brief about what was the scheme earlier was and what has been changed in that. Earlier we were investing at least 80% in sectoral thematic, but now 65 to 80% we will invest in equity. But here we'll not try to take a too much of a cash call until unless market valuation zooms up too much and our equity valuation index also suggests in a dark red. That time we will see whether we want to go below 80%. Otherwise it will be at till that point in time will be remain 80% invested in equity. So nothing changes as far as the equity portion is concerned, how we manage the equity portion. Earlier also we used to take skewed sectoral thematic exposure. Currently also we'll take the same thing. That earlier also we were 0 to 20. Now at least 20% will be there in the debt. In a way it will reduce volatility to some extent, because earlier I could have been in equity above 95 to 100 as well, between 95 to 100 as well. But now with the changes in this SID, it will be 80% equity. So in a way will reduce the volatility of the fund. But still 80% will be there in equity, which is, in the particular theme or sector. uh, yeah, yeah. So and see, earlier also, depending upon, the how valuation has fared, we have taken the cash call in the old SID also, where, we can go up to 20% in cash. There were a period when we have taken, the various cash call also. So from the overall return perspective, we don't foresee any major changes due to these changes. In a way also, it reduces the volatility, and gives us the more flexibility also. Yeah. So this is this fund. I think, obviously we need to now keep 20% in debt, so we have increased the exposure to debt, and which fund or themes we have used to fund this debt exposure. We have reduced the exposure to energy opportunities, uh, slightly bit of pharma and banking fund, and these are remaining the same. Now, key sector call that we have taken currently, where, we'll see the higher skew to particular theme or sector. Uh, One is tech. So latest, if you see holding, we have almost more than 20% exposure to the tech. Now, see, reason being here again, I'll urge, you to see the historical trend of this portfolio, how we have moved between the various theme or sector. So we started adding the tech somewhere in 2000 March April 2024, April 2025, when Trump started with that Liberation Day tariff, and we see the massive correction in the tech because of the, the global slowdown, risk, and all this thing. Earlier, if you see 6 months back, from April 2025 to 6 months back, we were having almost 0% exposure to the tech. uh, Here, see, firstly, let me just brief you the philosophy which we follow to take a exposure to particular theme or sector. So, firstly, we see from the cycle perspective where that particular theme or sector is featuring. Uh, what does it mean by that? So, from the revenue perspective and from the margin perspective, whether that particular theme or sector is at the top of the cycle or is at the bottom of the cycle, we try to see that. So, firstly, is that cycle. Then we see valuation. From the valuation perspective, where that particular theme or sector is featuring, whether the valuation is high, valuation is low, how the valuation relative to its own history, relative to its own fundamentals, and from the various macro perspective, how, what should be the valuation of that particular theme or sector, and what valuation at which it's currently trading. Third one is performance. We try to see how that theme or sector has performed historically, 1 year, 3 year, 5 year. What is the performance of that scheme? What is the performance of that theme or sector? Fourth, we try to see from the ownership perspective whether it is the under-owned theme or sector, or it is a over-owned. Uh, by that mean, we see FI holding, we see the DI holding, whether, they are they are underweight, they are overweight. And we try to see that the idea from this indicator is to take a counter cyclical view. This fund will never try to take exposure in a momentum way. This theme or sector which has done badly, which has underperformed, we try to take exposure to that particular theme or sector. While we see these parameters, but we also don't want to get into the value trap by following this parameter. So we try to see whether there are any triggers which can reverse this underperformance. We only don't look at the underperformance, but we try to see, is there any way, or is there any indicator that suggests, that underperformance that they are seeing currently, or whatever issues are there currently in that theme or sector, whether that can reverse or not. That is where we use this parameter to see, whether we want to do the allocation to that particular theme or sector. So based on that parameters and looking at the various macro indicators, while this as a serve as various initial filtration criteria, we come out with a particular theme or sector, and we do some more work around that particular theme or sector, like the normal fund manager will do in analyzing the fundamentals of that particular theme or sector, and we come at the allocation part. Now tech, obviously, if you see in that April 2025, when Trump imposed the Liberation Day tariff, I think there was a correction in the market. The valuation has become quite attractive for that particular sector. Uh, so we started building the weight during that period in time, and uh, we almost reach around 17-18% exposure, and uh, barring the last whatever 2-3 months, we have seen the collapse in the IT because of the AI related disruption. The sector was outperforming. If someone has invested in April 2025, was there just 3 months before, I think the sector has done relatively well. Now what has changed in last 3 months? There is a narrative that is getting building around that because of the AI, the sector will face the terminal growth risk. uh, Now see, it is just currently it is a hypothesis. Nobody knows in longer term how the AI will going to disrupt the IT services part. But whatever interaction we do with the companies, with the experts, what it suggests, that IT service provider will be needed to implement those AIs. And even if you see companies like Infosys, TCS have done the partnership with the Anthropics of the world, because Anthropic will create the tools, but to get it implemented at the client end, you need the IT service provider. Obviously, the dynamics of the sectors are changing, uh, but right now there is not clear that the role of the IT service provider will go to zero. Whatever we see currently, there will be a role of the IT service provider will remain. There will be some deflation, but there will be some additional work will also be coming because of this AI implementation. So net effects will be positive due to this. So, and if you see now what is in the price, if you see the at the current valuation, the implied growth that is coming for most of the large cap, at least IT stocks, it is 2 to 3% kind of a 2 to 3% kind of a long term growth, which is not a tough ask. I think whatever be the case, I think they will get to that level. And from the free cash flow yield, from the dividend yield perspective, if you see, I think they are trading at all time high valuation currently. TCS trading at almost 4 to 5% dividend yield. HCL Tech is trading at very high 4 to 5% kind of dividend yield. So the valuation comfort is there. The long term growth, what it implies, is quite achievable. Even if the disruption comes because of the AI, they are well prepared. The expectation is quite low at the current valuation. And if it doesn't happen in the way the bear case that people are expecting, then there is a decent way one can make a good return out of that. And if you see, even in last 1 year, I think the deal win also was quite strong for the company. That should translate into the future growth also. So from the cycle perspective, if you see last 2-3 years anyway, the sector is passing from the low growth. From the COVID, during the COVID period, there was a high growth phase. Post COVID, there was a the low growth phase because of the whatever reason, because of this the high base, because of the global uncertainty, whatever reason. And now war is adding another element to it. But we see the deal wins are strong, valuations are attractive, risk reward is quite favorable if one invest in this particular theme or sector. Again, from the sentiment perspective, there is all negative sentiments around this, and as a retail investor, it is easy to take a call that get out and just forget it. But as a fund manager, we think reverse, and that is what this fund try to do, think in the counter cyclical manner. And we have invested in this IT sector. Another one is a banking, where obviously, if you see recently, there is a monetary fiscal stimulus is also been given by the government, because macros are in a good shape, so they can do this whatever they have done. This will translate into the growth with the lag effect. Now because of this war situation, I think that is will slightly get delayed, but I think the growth will see pick up. And the interest rate cut cycle is also now bottoming out. That is also good for the bank. Credit growth should see improvement. So it is a banks, particularly the large private bank plus large PSUs are in a sweet spot currently. Valuation wise, I think they do not done anything great. Valuation wise is also they are attractive. Another one is pharma. Again, it's a defensive bet, and there are the because of this GLP-1 launch also there will be some earning based trigger also there. Valuation relative to markets are reasonable, and in a way will act as a defense also. And we have also, if you see from the basket perspective, within Bharat consumption, FMCG, and rural opportunity, we have decent amount of exposure to the consumption names also. Around 20% is invested between this scheme. Again, the thesis is same. Like you see, most of the staples company from last 1 to 2 years, they are passing through a low growth phase because the inflation was low. There was a higher competition from the unorganized segment. So the volume growth was low for the listed player. They are losing the market share. Now with this situation, that is getting reversed. And with GST cut, the gap between the unorganized and organized segment is also reduced. That will also help organized player to gain back the market share. On the other hand, the inflation is also slightly picking up, which is also good for the listed player, where they have a better pricing power. They can take a price hike, and again the unorganized player lose out there. And during this scenario, obviously the raw material availability has also been issue. The larger players are able to manage it well. Smaller player also obviously getting problems in getting raw material also. So that way the competition from the unorganized player is also easing. So I think the volume growth should pick up. Each quarter goes by, there should be an improvement. And again, when the volume growth comes back, there should be a re-rating happening in this name. And if you see from the performance perspective, they are completely beaten down. Last 3 years, in fact, you see, or in fact, of 5 years, there is no return from these companies. So from that perspective, I think they are also attractive, that consumption basket. Yeah, so this is from the thematic fund perspective. Yeah. The last one is this is so one is from the asset allocation, one is from the theme or sector allocation, and third one is from the market cap allocation. How much you want to invest in large cap, mid cap, and small cap. So asset allocator from the risk perspective comes in the lower end. Thematic advantage comes on the higher end, and this will come slightly lower than the thematic advantage fund, because this fund will invest in the diversified large cap, diversified mid cap, diversified small cap fund. So you'll get exposure to lot of sector with lower volatility it's compared to thematic, but obviously it is again a all equity fund, so volatility will be higher than the asset allocation. So again, if you see, like debt and equity behave differently, there is a market cap segment which behaves differently. So there is a point in time where Nifty would have done better, there will be a point in time where mid cap have done better, there will be time where the small cap would have done better. So each segment provides a different return at different point in time. And again, here if you see, what was I was showing in that asset allocator slide, investor always behave in the pro cyclical manner. Now you see this this is an investment in the mid cap segment. Now 2070 to 2000, I think earlier that period 2006 to 17, I think mid cap has done quite well, and we have seen a decent inflow during this period. But what has happened after that, the category has given a negative return. So investor always behaves in the pro cyclical manner, and they chase the momentum. And you see that after that, if you are investing at the higher level, the return experience is much inferior. Same is the case with the small cap. There is a decent inflow in this segment. At the top, we get the highest inflows, and then we see the negative return. So again, this is a confusion for the investor. Which segment to invest. We try to solve this problem. Uh, yeah. So as I was mentioning, there is various ways like thematic scheme through which we can create alpha, to sectoral, and from the market cap base. So this is a solution for the investor, who is confused, which segment to invest in. So again, the broad framework philosophy, we try to follow the counter cyclical approach. We try to see price to earning, price to book, various quantitative indicator of various segment, large cap, mid cap, and small cap, and we try to allocate the investment within that segment. Here, investment universe, we use only the market cap based scheme, means large cap, mid cap, small cap, flexi cap, those multi cap, those kind of a fund where we will invest here. We study various macro parameters, macro, micro, and some technical parameter to come at the allocation. How much we want to invest in particular uh, market cap. In a way, this will also give you exposure to various style, because there are various schemes run in the different style. Large cap would run in some growth, flexi cap will run in following the growth style, because see, each fund manager will also have a different style of investing. Particular fund manager will like to follow the growth philosophy, particular investor will like to follow the value strategy. So with different fund manager, different scheme, we get exposure to different styles also. Yeah, these are the return, I think. Yeah. So right now, I think with mid cap and small cap seeing some correction, I think the percentage of the total market cap, I think, has reduced, and that is become slightly attractive to invest in this mid and small cap segment also. Yeah, I think this is the various scheme we have. So this is the snapshot of return. If you see how the thematic advantage fund has done over a period of time, these are the just return data point one can see. This is a dynamic asset allocation, is the asset allocator fund. Again, this diversified all cap omnis also invest in the market cap form. Here we also invest in ETF, whereas first fund only, the all cap fund which I just explained, will invest only in the schemes, mutual fund scheme, not in the passive schemes. Yeah, I think this is it. Thank you.